Have you ever wondered what the secret to successful investing is? It's not about having a fortune to start with, but understanding the game, the strategies. In the labyrinth of investing, two concepts stand tall: target date funds and compounding interest. These aren't just financial jargon, but keys that unlock the treasure chest of wealth accumulation. So, buckle up as we embark on this fascinating journey of understanding these concepts and their significance. Stay tuned as you unravel the mysteries of target date funds and compounding interest, two critical components of successful investing. So what exactly are target date funds, you ask? Well, let's dive right in. Target date funds, also known as life cycle funds, are essentially mutual funds with a twist. They are designed with a specific date in mind, usually your estimated retirement year. The beauty of these funds lies in their simplicity. You select a fund with your target date and voila, you're invested. But how do they work? Well, target date funds are managed by professionals who handle the asset allocation for you. These fund managers adjust the mix of stocks, bonds, and cash equivalents in your portfolio as your target date approaches. When you're far from the target date, the fund is typically more aggressive, investing heavily in stocks for growth. As the target date nears, the fund gradually shifts towards more conservative investments like bonds and cash equivalents, aiming to preserve your accumulated wealth. The benefits of target date funds are considerable. You get professional management, diversification, and automatic rebalancing, all in one package. Diversification spreads your investments across various asset classes, reducing your risk. Automatic rebalancing ensures your portfolio stays aligned with your investment goals and risk tolerance over time. Remember, target date funds are not just for retirement. They can also be used for other future financial goals like saving for your child's college education. With target date funds, you're essentially putting your investment on autopilot, letting professionals do the heavy lifting for you. Sounds like a stress-free way to invest, doesn't it? Now let's dive into the magical world of compounding interest. Imagine you're in a forest and you plant a single acorn. This acorn grows into a mighty oak tree, dropping more acorns which in turn grow into their own oak trees. Over time, what started as a single acorn becomes a sprawling forest. That, my friends, is the essence of compounding interest. But let's get a tad more technical. Compounding interest is the process where the interest you earn on your investment is reinvested, allowing you to earn interest on your interest. It's not just your initial investment that grows, but also the interest it generates. Picture this. You invest $1,000 with an annual interest rate of 5%. At the end of the first year, you've earned $50 in interest, bringing your total to $1,050. Now here's where the magic happens. In the second year, you're not just earning interest on the initial $1,000, but also on the $50 you earned in year one. The secret sauce to maximizing the power of compounding interest is starting early. The sooner you start, the more time your money has to grow. It's a race against time, and the clock starts ticking the moment you make your first investment. Remember, compounding interest is like a snowball rolling down a hill. It grows bigger and faster as time goes on. You might be thinking, what does time have to do with all these? Well, let's delve into the concept of time in the market versus timing the market. Imagine you're trying to catch a train. Do you wait for the exact moment when it's about to leave, risking missing it altogether? Or do you arrive early, securing your seat and ensuring you're on board when it departs? This analogy applies to investing too. Many people believe they can outsmart the market, buying low and selling high. But the market is unpredictable, and timing it perfectly is nearly impossible. Even seasoned investors struggle with this. Conversely, time in the market is about starting as early as possible and staying invested. Let's illustrate this with an example. Consider two investors. One starts investing a small amount early and stays in the market, while the other starts late but invests larger sums. After several decades, the early bird investor, despite investing less money overall, often ends up with a larger portfolio. Why? Compounding interest. Their money has had more time to grow and compound, leading to significant gains. Studies have shown that missing out on the market's best days can drastically reduce your returns. So instead of trying to time the market, focus on time spent in the market. Time in the market, not timing the market, is the key to harnessing the power of target date funds and compounding interest. To wrap everything up, we've journeyed through the landscapes of investing, target date funds, and the magic of compounding interest. The key takeaway? Start investing early. It's not about how much you put in each month, but the length of time you're in the market. consider target date funds as a viable choice for retirement planning. Remember, the earlier you start investing, the more you can take advantage of target date funds and compounding interest. Happy investing.